Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me for the first time Christopher Mayer. Chris learned how to value companies as a corporate banker, so he and I have that in common. I also was a credit analyst and then a lender at one time, so that's a good background, I think, to have in terms of understanding businesses and companies. And Chris also has an MBA that he picked up along the way. And in 2004, he founded Capital in Crisis. That's a newsletter that I have a couple of copies of here, thanks to Chris, who sent them my way. And his second letter, Mayer's Special Solutions, or Situations, I should say, Mayer's Special Situations, he launched in 2006, and that expands his coverage and focuses on spin-offs, thrift conversions, and stocks from around the world, and much more. Chris is quite frequently on the media. He's been on CNN Radio, Fox Business, Forbes on Fox, Russia Today, and a multiple of times on CNBC and radio appearances. So also contributes to and has contributed to the Washington Post. Thank you for joining me today, Chris. It's really good to have you with me.
Hey, Jay, thanks for having me on. Good to be with you.
I've heard a lot about the Agora Group. How many people work for Agora? How many analysts and newsletter writers are there in the Agora, under the Agora tent?
Oh, wow. Well, I can't count.
Yeah, there's a lot of different
There's
people.
a lot. They're all over the place, and there's many different groups within Agora. So there's Agora Financial and Oxford Club and Stansberry Associates, and each of them publish a dozen newsletters.
Oh, I didn't realize Stansberry's a part of that. Okay,
yeah.
All right. So it's a big umbrella. Lots of really smart people writing newsletters there. And before we get started, though, let's ask you, where's the best place to go to follow all that you do? Just so I want to get that out of the way, because sometimes I forget, and I think it's only fair to our guests to let them tell people how they can follow their work thereafter. So if people wanted to pick up on what you're doing, where can they go?
Right. Well, I think one of the easiest places to go would be to go to thedailyreckoning.com. I contribute there, and that's a free e-letter, so you can search around, read essays of mine, and then click on different links to learn more about my letters. That's the easiest way. Okay.
And also they could get you at Agora, I think, probably
as
well.
Yeah, agorafinancial.com. So you can certainly find that. Google that, and it's easy to find.
Yeah, and I might mention to our listeners that your Capital in Crisis letter is very reasonably priced. I see $49 a year or something like that. So it's
correct.
Your other one, the Special Situations, is a little more expensive. What do you give there? I guess it's a lot more detailed work and more frequent letters, or what do you get on Special Situations that you don't get with Capital in Crisis?
Right. Well, with Capital in Crisis, I'm mainly focusing on securities that are easy to buy. They're all in the New York Stock Exchange, the NASDAQ. And they're pretty liquid. And in the Special Situations letter, I get into much more quirkier opportunities, so they might be stocks that are listed overseas. I get involved in spin-offs, and sometimes these things can be less liquid. And so the price is higher, and there are a lot fewer readers there. That's
sure.
Kind of really the difference.
Sure. Well, I have to ask you about this, because I saw somewhere in your bio or somewhere that you have never lost money. Is that correct, or was I smoking something funny with it?
No, I've never lost money as a corporate banker. You mentioned earlier that I was in corporate banking, and I also started out as a credit analyst, and then I was a corporate lender for about a decade. And in that time, I never lost money in a deal. That's not to say that a loan I made didn't go bad. They did go bad, but we had collateral and were able to work our way out of it for a profit. So that's the deal there. And I certainly agree with you. That's a great experience to start there.
I think so.
Value companies.
Yeah, absolutely. Now, when were you doing your lending? Give me an idea, a perspective of the time frame that you were a lender.
In between 94 and 2004, and in 2004 I started Capital in Crisis.
Okay, so I left ING Barings in 1997, so I was there. And one of the things that I noticed that was starting to happen, I live in New York City, worked as a credit analyst for several major banks in New York City, mostly foreign banks, but what I noticed was towards the end, well, first of all, when I first entered the market, and that was a lot earlier than that, there would be 2 full pages of credit analyst ads for, jobs for credit analysts. And now if I go to the New York Times, I won't find hardly any credit analyst ads. Of course, things are different now. People do everything online. But even during that time, it seemed as though what banks were doing were packaging loans and spending far less time and energy in analyzing individual companies and especially smaller borrowers.
No,
was that your experience?
Exactly right. I mean, when I started, that was just on the way out. In fact, I started my banking career with Riggs in Washington D.C. And when I came in there, I was the last credit analyst class that they brought in. I mean, they would normally do is they'd hire, bright kids out of college and put them through a 2-year credit analysis training program. And I was the last class that they did that. So all that stuff kind of was going on the way out when I was getting into banking. And you're absolutely right. It's what's interesting. The banks that I work for no longer exist. They didn't make it out of the Great Recession, and the reason is that they got trouble. They got in trouble with all that kind of package stuff. So it wasn't a corporate lending that I was doing. We were looking at companies and underwriting them, and we had all kinds of very high standards as to what kind of loans we would make. But meanwhile, the Treasury Department of the bank would buy and sell, millions of dollars worth of bonds on an S&P report, a credit rating report. It was a real strange dichotomy, and ultimately it was that carelessness that sank them.
Yeah, well, that's what went on, and I mean the idea was that you could just buy a bunch of different things, throw them together, and you'd have a certain percentage of them would go bad. You'd price that into the interest rates that you would charge or the pricing somehow, and you'd come out ahead on that. Well, that worked as long as until it didn't, I guess.
Yeah.
And then,
well, I think actually, the basic bread and butter of banking is pretty simple. If you know your customer and you make loans, just like you said, you price certain things in. You have a certain amount you're going to lose, but it's a pretty decent business. When you try to get tricky and complicated, and you get greedy, then you get in a lot of trouble easily.
Well, know your customer meant one thing when you and I were in that industry. Now it means know what your customer is up to, and if you see something, say something to your government. So it seems like the banks are being asked now to be more like police state administrators than than knowing your customer.
Because I still have friends in the banking industry, and they will tell me all kinds of horror stories about the amount of paperwork and the things they have to report on. It's really unbelievable. And, of course, this is one reason why it's so hard for an American citizen to have a bank account abroad. So many banks now will just not deal with U.S. citizens because of all the regulatory burden implied in having a U.S. customer.
Oh, I know very well how difficult it is even to get a small amount of money up to Canada to buy a private placement if I want to do that. So it's everything is more difficult. Well, Chris, it seems like your background or your approach to investing has more to do with more of a microeconomic or say economics of the firm. You wouldn't necessarily be focused in any one sector. You're very much diverse, and you go to you go wherever you can go to make some money. So help us understand a little bit what your approach is. What's your filter? How do you figure out what you want to tell your subscribers to buy?
Yeah, I'd say I blend a little of both. I mean, certainly write about big picture trends and macro and things that are going on in the banking sector, and explaining to my subscribers things like QE and the mechanics, how that works. And so I do blend those approaches, and I do look at sort of some top-down trends that are interesting. But ultimately, when I do recommend an investment idea to my readers, it has to make sense in that bottom-up sort of way. And there's an acronym I have, CODE, C-O-D-E, which sort of sums up those points. So the first thing to see is I'm looking for cheap. I'm trying to buy things generally below replacement cost or some discount to net asset value. The O is for owner-operators. I only invest in stocks where the people in control have significant skin in the game, where they're aligned with our interests. The D is for disclosures. Comes back from my banking career. It has to be something I can understand. The public disclosures have to be adequate and clear. And then E is for excellent financial condition, meaning that only stocks I recommend are companies that have great balance sheets and can withstand, turbulence.
Yeah. Well, certainly we've had a lot of turbulence in recent years, and I don't know, you in your most recent newsletter, as your December issue, you put out, you said you started it out by saying the next financial crisis will begin in China. I guess you do cover a top-down approach as well then. Talk to us a little bit why. You said something about you would treat Chinese investments as if they have Ebola. What? That's a pretty strong statement. I guess to some of those, the code issues that you're just talking about, maybe disclosure comes into play with Chinese investments?
Yeah, disclosure would be the big problem. And I should say, I've been writing a newsletter for now almost 11 years, and, my opinions shift and change. So again, this is one of those things where early on I was pretty bullish on China. We actually had some Chinese investments and did well on some of them. In fact, I think there was only one where I lost money, and that was the one that scared me enough to get me out of the rest, and it was over a disclosure issue. It was an issue where we had a bank that, we had a company that had a big name auditor and went public on the New York Stock Exchange. It wasn't one of these reverse mergers. And it turns out the cash on the balance sheet was reported as being unencumbered when, in fact, it had been used as collateral for loans to the insiders. So,
oh boy! After
that, and this is a case where I have known people. I was in Beijing. I met with people there. I had a very savvy investor who spoke Mandarin, and I mean, you just did all the due diligence you could possibly do, and that happened. So. Yeah. That was part of what made me change. But then in the macro sense, the macro situation in China has clearly deteriorated. And you can see it in the debt levels of the companies involved and their declining profitability. And, those are the things I'm starting to look at. And I think that at some point they're going to have that kind of credit crunch. I mean, the amount of credit that has been created in China since 2008 is really just astonishing. Yeah. And, you don't have that kind of credit growth without having seeded some bad loans and problems along the way. So how that will play out, I don't know. I mean, the Chinese government certainly has a lot of control over the banking system and can bail these things out, and perhaps that will happen, but I would rather not be there when it does.
Yeah, indeed. It could have a global effect, I would think.
Yeah, well, that's the other thing is what, the more important question is what's the ripple effect of having a Chinese credit crunch. I mean, they're such a large consumer of commodities that's the one I think of initially, is that their demand for things like iron ore and copper and would fall. Yeah,
we would think so. I was just listening at a lunch break here in New York to Bloomberg, and they had a guest on with Kathleen Hayes talking about the housing slowdown now, and this gentleman thought that the next 5-6 years China was going to be experiencing a significant decline in their housing prices so we'll see the real estate prices. Things are going to go through the same kind of ringer that we went through, and Spain and Ireland and other countries have gone through recently. So I guess that could be part of it as well, and certainly. We've heard about these cities that are built and nobody's living in them. They certainly consumed an awful lot of copper and iron and all kinds of other things that drove prices up and allowed people to make a lot of money. But now, if it goes in the other direction, certainly we're seeing a lot of weaknesses in oil and other things now. But I have to ask you, one video that I saw you did on the internet has to do with quantitative easing and why we're not getting any inflation. The old idea was, and a lot of my gold bug friends are absolutely convinced that we're going to have hyperinflation with quantitative easing pumping trillions of dollars into the banking system. Explain to our listeners why that's not necessarily the case.
Yeah, I think that you have to think about the mechanics of what QE does. I think QE is not inflationary. Mm-hmm. And think about it this way, is that you have the private sector, let's say you have the non-government sector who owns Treasury securities, and they're earning income from those Treasury securities. It's part of their savings. And then the central bank decides to come in, and they're going to buy these Treasury securities and replace them with a bank deposit. So what happens is that at the end of the day, instead of owning Treasury securities, now the non-government sector has a bank deposit. Why is that inflationary? Because you think about it, they had a bank deposit to begin with. They bought the Treasury security. Yeah. Now the central bank is coming in and really reversing that transaction. It's almost like the debt was never issued at all. And so the private sector then loses the benefit of that income, and where is it? I mean, the central bank has it, hands it to the Treasury. So it's almost like, in effect, a tax. If anything, I think QE has a deflationary bias.
Oh.
The other thing to point out is people say that there builds up all these excess reserves and somehow that's going to be inflationary. Well, I mean, the people who say that don't understand reserve accounting, because the banks do not lend out reserves. Those reserves are bank assets, and they're held at the central bank, and they get their 25 basis points for putting it there. But it's not like that money leaks out in any sense, because the banking system can lend just as much as it could before it had those excess reserves as it does now. The excess reserves are independent of banking system's ability to make loans. So I think what we really see now is we see a dearth of qualified borrowers and willing lenders. That's what would get the next big inflation cycle moving, is you have that, and then you starting to see the money circulate a little more, start to see some asset prices increases and that kind of thing. But otherwise, I don't see us experiencing any exceptionally high level of inflation other than just the inflation we've generally become accustomed to.
Yeah, we were seeing certainly purchasing power of the middle class is being decimated. Maybe that's too strong a word, but certainly in decline. We're seeing a redistribution of wealth to a smaller number of people at the top that are in the equity markets and elsewhere.
No question. That's the thing. What QE really did was it gave the people at the top of the pyramid a bit of a handout, because they were able to benefit from the kind of asset boom. And the other thing about QE is that there's not really any specific mechanism where you would say, okay, well, QE is going to drive stock prices higher. It seems to me almost psychological if people believe that that's the case. And it sort of gets to what I think is one of the defining features of our market since the crisis is this belief that central banks just kind of make the markets jump, when they want to. And at some point, I think that belief will be tested, and people will realize that, the stock market can still be cut in half, even if they're quantitative easing.
Well, we certainly saw the equity markets respond on around October 15th when one of the Federal Reserve officials suggested that maybe we wouldn't stop QE. And then, of course, the Fed announced that it was stopping QE. But immediately right then, the Bank of Japan came in with a tremendous amount of new stimulus, and the equity market, though, seemed to like it. So it does seem to be having an effect on the equity markets, but it isn't getting into the real economy. That seems to be my read of it.
That's exactly right. I would agree with that 100%. It seems to be something that makes the equity markets jump. And whether that's right or wrong, we'll see. I again think that that's more of a psychological thing than any real connection between the two. But if people believe sunspots make the market goes up, then that's what's going to drive the market, at least for a while.
Yeah.
But I think the point you made about it not leaking into or not affecting the real economy is also right. I mean, that's why we've had such a sluggish recovery, and that's why when you talk to most people, their feeling is the economy is not particularly good, even though the stock market's at all-time highs.
Yeah, there's a disconnect there. It doesn't make sense. It should be the stock market is being driven. Of course, equity profits are going up to a certain extent at least, because of share buybacks and various other schemes, I suppose.
Yeah, I mean, I think the stock market doesn't necessarily have to dance with the economy. And in fact, if you look back, there's all kinds of studies I've seen when you look at compare the highest GDP growth countries with the lowest GDP growth countries. The best performing equity markets actually happen to occur with the lower growing GDP countries rather than the high growth countries. So, I mean, there's all kinds of reasons why that might be. I mean, it might be pricing, right? I mean, equities, the return you get from equities depends on the price you pay. That's part of it. But part of it also is that you can have good profits and you can have a healthy corporate sector that doesn't necessarily mean you have a great looking economy. I remember too, and you probably remember this too, I think it was a couple of years ago, where Greece had one of the best performing stock markets in the world.
Yeah, that's right.
Meanwhile, the economy was contracting 25%. So
yeah. So what should we do? What should policy do? Should our policy makers letting interest rates rise?
I'm not really all that interested in policy, but I guess if I had to say, I wouldn't get the central bank out of the interest rate business entirely. I wouldn't bother trying to manage it, and so I might not issue bonds at all. And if the government's going to buy something, just you pay for it directly and you credit a bank account rather than try to manage, rather than trying to sell a bond, and then have the central bank not bother to pay any interest on reserves. Just drop all that to zero and let the market decide what the price of money should be.
Yeah, so certainly would be agreeable to me, but at the same time, it doesn't seem as there's any chance that the policymakers are going to change anything. As you say, if people believe in sunspots and it drives the market up, it can work for a while. Yep. But I was just a quote here from the ECB, Yves Mersch, an executive board member of the ECB, posted on their website today, the Board of Governors has unanimously advocated, where appropriate, to take further unconventional measures to counteract a lengthy period of lower inflation. Mm-hmm. Theoretically, this also includes the purchase of government bonds or other assets such as gold, shares, exchange-traded funds, etc. Yeah. Now, that's the religion of the day. The Keynesian religion of the day is to stimulate through all this monetization of everything under the sun. And I don't know, but again, your focus, more importantly, is on what can you make money. So in this kind of environment, my engineer tells me we only have a minute left, so it's not fair to ask you this. Maybe some other time. But what are you doing? I mean, you're looking at companies that can make money in any kind of environment that can survive the stress that comes our way as a result of this foolishness from policymakers.
That's correct. I mean, I'm looking at companies that have super strong balance sheets. They've got a lot of cash. They've got a smart, proven owner-operator at the helm who's got a lot of his personal wealth invested in the company. Maybe he's even buying stock. And, this is one of those weird times, Jay. I wish I could just tell you and say something like, well, I think the banking sector is cheap or oil stocks are cheap. But it hasn't been that way for the last year. It's really been a stock-picking kind of exercise. And I found that the portfolio, I'm just picking up little things here and there. It's not necessarily unified in any great theme.
No, it's not, and I should mention that we're out of time, but to catch up with Chris and what he's doing, thedailyreckoning.com is where you need to go, thedailyreckoning.com. You can follow up on what he's doing, but just to give you an idea, some of the names on there, very diverse group of companies, Howard Hughes Corp., Kennedy Wilson, First Citizens Bank Shares, Capital Senior Living. I'd love to know more, Chris, to find out why you like those, but maybe another time. I want to thank you very much for being with us today.
Thank you very much for inviting me, Jay. I enjoyed it, and sure, I'll be on any time with you.
Yeah, I'd like to hear some of the stories that you have in your letter. Thank you very much for being with us.